Welcome back to Zog. Today we talk about global interest rates and how it affects investors. Global interest rates play a significant role in shaping the investment landscape and influencing investor behavior. Interest rates are set by central banks and have a direct impact on the cost of borrowing, the returns on investments, and overall economic activity. Here's how global interest rates can affect investors. 1 is cost of borrowing. When central banks raise interest rates, borrowing becomes more expensive. This affects both individual investors and businesses. Higher interest rates increase the cost of mortgages, car loans, and other forms of credit. As borrowing becomes costlier, consumer spending and business investments may decrease, leading to slower economic growth. 2 is bond investments. Interest rates and bond prices are inversely related. When interest rates rise, newly issued bonds offer higher yields, making existing bonds with lower yields less attractive. This can lead to a decrease in the value of existing bonds, potentially resulting in capital losses for bond investors. Conversely, when interest rates fall, bond prices tend to rise, benefiting bondholders. 3 is equity investments. The relationship between interest rates and stock prices is more complex. Generally, higher interest rates can lead to higher borrowing costs for companies, potentially affecting their profitability. Additionally, higher interest rates can make fixed income investments like bonds more attractive relative to stocks, causing some investors to shift their allocations away from equities, which could put downward pressure on stock prices. However, other factors like economic growth and corporate earnings also play a role in determining stock prices. 4 is real estate investments. Real estate is sensitive to interest rate changes. Higher interest rates can lead to higher mortgage rates, reducing the affordability of homes for potential buyers. This can lead to a slowdown in the real estate market and potentially impact property values. Conversely, lower interest rates can stimulate real estate demand by making mortgages more affordable and potentially driving property prices higher. 5 is currency impact. Higher interest rates in a country can attract foreign capital seeking higher yields, potentially leading to an appreciation of the country's currency. This can impact investors holding assets denominated in that currency. An appreciating currency can reduce the returns on foreign investments when converted back to the investor's home currency. 6 is global investment flows. Investors often seek the best returns for their investments. If one country's interest rates are significantly higher than others, it can attract capital inflows from investors seeking higher yields. This can affect the overall investment climate in various regions and influence currency exchange rates. 7 is risk appetite. Interest rates can also influence investors' risk appetite. When interest rates are low, investors may be more willing to take on additional risk in search of higher returns. Conversely, when interest rates rise, the appeal of safer, fixed income investments may increase, leading to a shift away from riskier assets. It's important to note that the relationship between interest rates and investments is not always straightforward, and other factors, such as economic conditions, geopolitical events, and market sentiment also play crucial roles. Investors should consider a diversified investment strategy that takes into account their financial goals, risk tolerance, and the current interest rate environment. For more information, talk to Zog at hellozoginvest.com.